Welcome back, everyone. We've made it to day 21 of the FinFlow Media 100-Day Wealth Challenge. And wow, today's explainer tackles what is literally one of the most critical decisions you will ever make as an investor. We're looking at the massive, high-stakes risk of individual stock picking versus the unmatched, automated safety of index funds. If you're serious about building real, long-term wealth, understanding the mechanics separating these two strategies is absolutely crucial. We're going to break down the underlying math, the structural risks, and exactly why one of these approaches offers a mathematically superior path to a secure financial future. So you ready? Let's jump right into the stakes.
Okay, let's dive into this. I want you to think for a second about who you're actually competing against when you try to pick individual winning stocks. You're going head-to-head with Wall Street institutions. We're talking about highly specialized professionals equipped with billions, literally billions of dollars in deployable capital. They've got armies of analysts with PhDs and actual supercomputers executing trades at fractional milliseconds based on real-time global data. So, if these incredibly resourced experts struggle to consistently pick winning stocks, and spoiler alert, they absolutely do, you've really got to ask yourself, why on earth would you gamble your hard-earned money trying to beat them at their own game? Unless you've got a quantum supercomputer hiding out in your garage, this is a high-stress, unwinnable arms race, and the odds are fundamentally stacked against us retail investors.
The reality of that David versus Goliath matchup is just staggering once you actually dig into the data. Check this out. 90% of professional stock pickers completely failed to beat the market over a 10-year period. Just let that sink in for a second. 9 out of 10 professionals. These are people whose entire livelihoods, reputations, and massive bonuses are built around analyzing the market all day, every single day, cannot outperform a basic benchmark over a decade. Why? Well, it's a mix of exorbitant management fees eating into their margins, the inevitable emotional friction of trading, and the simple fact that global markets are wildly unpredictable. When you see a failure rate that astronomically high among the experts, it immediately exposes how dangerous and, frankly, illogical it is for everyday investors to try and outsmart the market through active trading.
And this brilliantly illustrates the exact mechanics of where that danger lies. Look, when you buy a single stock, you are willingly stepping into a massive concentration risk trap. Your entire financial upside in that specific investment relies completely on one single company's ecosystem. If that company stumbles, say a bad earnings call, a sudden supply chain crisis, or some unexpected leadership scandal, your net worth takes a severe and immediate hit. There's zero buffer. But an index fund? It offers a structural solution by instantly dispersing that risk. Instead of tying your fate to a single corporate entity, an index fund allows you to buy a tiny slice of hundreds of top-performing companies all at once. The volatility is smoothed out instantly.
We all know the benchmark standard here, right? The S&P 500. But I want you to really think about what utilizing an S&P 500 index fund actually means in practice. You aren't just making a bet on the tech sector or retail or healthcare. You are securing a fractional monopoly on America's 500 largest, most dominant businesses simultaneously. It's essentially an automated, long-term wager on American corporate capitalism as a whole. You capture the massive economic engines of the country without having to guess which specific engine is going to run the fastest in any given quarter.
Let's move to and see how this builds, because since you own that broad slice of hundreds of companies, the index fund basically operates with these built-in Darwinian self-cleansing mechanics. Think about corporate history for a minute. Decades ago, massive giants like Sears or Blockbuster seemed completely invincible until they weren't. If you held them as individual stocks, you lost everything. But in an index fund, what happens when a formerly great company underperforms and eventually falls out of the top 500? It simply gets dropped. It gets replaced by the next rising star, and the index marches on. Dozens of other successful, growing companies within that same fund naturally step up to carry the weight. The relentless strength of the collective completely insulates you from the inevitable failure of individual corporations.
And the historical proof that this collective strategy works? It comes down to one powerful metric: 10%. Historically, the S&P 500 has delivered an average annual return of roughly 10% over long periods. While Wall Street professionals are frantically trading, paying massive transaction fees, and largely failing to beat the market, simply owning the market quietly generates this incredible compound growth. It completely removes the anxiety and the guesswork from the equation, replacing it with decades of historical consistency. When we take a step back to evaluate the core pillars of smart wealth building, the advantages really are undeniable. Investing in an index fund is profoundly simple. It's low cost, meaning you actually keep your returns instead of bleeding your wealth away to fund a hedge fund manager's brand new yacht. And perhaps most importantly, it's completely automated.
Look, index funds are famously boring, but you know what? In the world of investing, boring is usually what makes you rich. You don't need to obsess over earnings reports, you don't need to stare at volatile stock charts, and you definitely don't need to panic when the daily news cycle turns negative. This strategy offers the ultimate luxury: absolute peace of mind. You know your money is working systematically in the background while you focus on actually living your life.
So the crucial point is, everything we've explored today boils down to this exact philosophy. Stop gambling on hyped-up stock picks and start owning the entire market. We've seen the incredible failure rate of professional traders. We've examined how dangerous single stock concentration risk is to your portfolio, and we've verified the historical compounding power of index funds. Owning the market isn't just the safer route. The data definitively proves it's the smarter, more effective route for securing your financial independence.
Which brings us to a critical choice. Will you continue to gamble in a game rigged against you, or will you build wealth the smart, stress-free way and join us for day 22? I really hope this breakdown completely changes how you view the stock market and empowers you to make decisions based on data rather than hype. Be sure to hit that subscribe button and drop a like so you can continue your wealth challenge journey with us tomorrow. Thanks for tuning into this Explainers, and we'll